Another set of positive tech earnings fails to excite stock markets. We, of course, had Tesla fail to excite them last week. Now, Alphabet, Google's parent company, struggling to do the same. And overnight results from Microsoft and Meta, which on the surface look fairly strong, at least not meaningfully worse than expected by any stretch, they're failing to excite markets again, also. See how that dust settles. But in macro land, things are on the move. And that's what we're going to focus on here. This is appropriately enough macro money. I'm Ilya Spivak, head of global macro here at tastylive. And what we're going to do here is take a look at what's occurring beyond stock markets, which are looking listless here, and consider instead what is going on in the economic data universe here, because where we've ended up is smack in the middle of a huge rethink on all kinds of expectations for monetary policy, or at least the opportunities for those rethinks to continue, because we have a flood of macro data that has kicked off this week. We still have a lot of the meat ahead of us, but the beginning of what we have been waiting for this week with all of this event risk, that has already started, and the results are frustratingly inconclusive as we get into what will be the next round of economic data coming up in front of us. So what we are going to do here is first take a look at how markets have fared so far as we get to this avalanche of economic data, and then see what comes next and what it may do from here as we see all of this register across the various assets. So let's begin here with just a look at the way the markets performed today, which is kind of a strange hodgepodge of outcomes. So again, we can see soggy results from stock markets. In fact, the NASDAQ actually leading the broader S&P on the downside, because despite these upbeat earnings reports that we've seen, it is the tech side of things that's kind of soggy. Now, the accounting scandal that we see here appear in the semiconductor space probably isn't helping, but one would think that you would have an offset from positive earnings, because that seems more idiosyncratic of a risk. But no, stocks struggling to make hay, yields up on the day ultimately, which is a wild reversal. Earlier on the day, bonds were up significantly and yields were on the defensive, especially toward the longer end of the curve. But now yields end up finishing the day with gains. And that is an interesting narrative here, because gold, despite higher yields, again manages to climb. It's been bucking higher yields for the better part of 2 weeks here. Very uncharacteristic for gold. The U.S. dollar, something of a mixed bag, but mostly lower, a touch off the 6-week high it reached yesterday. So overall still quite strong, but a touch lower today, with most of the gains happening for the euro. All of that seemingly coming together to tell a mixed, unclear, disunited, as it were, narrative. Now, where yields got a little bit of a seesaw is from conflicting cues in U.S. economic data that left little to say of substance about the move in Fed policy expectations. So first, we had the private sector estimate of U.S. jobs growth from ADP. That showed us a rise in payrolls of 233,000 in October, which was the biggest since July 2023. Strong upside surprise there. On the flip side, U.S. GDP numbers for the third quarter, one of the big tentpole releases we've been waiting for this week, they ended up looking a little bit soggier. Those numbers giving us annualized growth of 2.8%, a little bit lighter than the 3% expected, and as we saw in the second quarter. By no means catastrophic and mostly anticipated. The Atlanta Fed GDP Now growth tracker had that 2.8 number a day early in their model, but nevertheless, something of a conflicted picture. So bonds initially rally, then sell off, and we even end up with a little bit of a rise in yields. Crude oil marching to the beat of its own drum. It was down yesterday. It's up a bit today. It's little changed on the week between those moves. And probably the more interesting bit where we can actually make some key connections is the euro. It certainly outperformed, and that was after mostly better than expected GDP growth data. Taking a look at the quarterly numbers here, France better than expected, both quarter on quarter and year on year. Germany, likewise, and although things actually are shrinking in Germany year on year, it's by a smaller margin than expected, and on the quarterly, we saw an unexpected rise. Italy looking a little bit soggier, and when you dump it all together and average it out, you end up with Eurozone GDP that in quarter-on-quarter terms increased by twice as much as was expected. And that, of course, not surprisingly, gave a little bit of a lift to the euro as we saw that rate cut expectations diluted a bit. Here's what we're looking at there. We can see a bit of an upshift here. The markets seemingly clawing back expectations for how many rate cuts we're going to get both this year and next. So this sum actually edged into a more hawkish direction. We're, of course, still primed for cuts, but the likelihood that we are going to get one more cut this year, at this point, still high, but not certain, about 86%. And then for next year, we're looking at about an 84% chance that we get four cuts, or if we look at it in a cumulative way, we're looking at three cuts already fully baked in, and the probability of a fourth one next year at about 20-ish, 25%. So we're looking at an extension of this adjustment after these numbers. Over the course of the next day, this is where things get interesting. Overnight, the German version of inflation data is already out, and we can see it's a little bit hotter than expected, which no doubt helped this story in the euro. 2% versus 1.8% expected on the headline rate. And that, of course, underpins stronger GDP numbers and helps to get you to a less dovish ECB in the outlook. But now we are going to get the other inputs into the story. The French numbers, the Italian numbers, and the region-wide. And for the region, we can see here that the expectation is we are going to come down, or come up rather, to 1.9% from 1.7. That would be a slight increase, not really the biggest adjustment in the world, but a little bit of an uptick, and to the extent that we've seen the euro be reactive to what's there in these numbers, it could certainly be a further upshift. However, if we look at the leading PMI data that precedes this, This is from S&P Global and the Hamburg Commercial Bank. We can see that the region-wide numbers for October actually had the slowest rise in output costs. Those would be the ones faced by consumers since February of 2021. And in Germany overall, the fractional pace of inflation was the slowest since January of 2021. Now, obviously, the German bit here doesn't perfectly line up with what we saw in the overall numbers, so that's one reason to take this bit with a grain of salt, but also sequencing matters. And so when we consider that output prices overall were the slowest since February 2021, it's possible that that doesn't show up in Germany with the same timeline as it would in, let's say, France or Italy or the region overall. So that for the overall numbers, we end up with that significant of a price decline does suggest you could get a bit of a downside surprise, especially if, after the German numbers, the markets are already primed, not only for an uptick in CPI, which is already baseline in the forecast, but maybe an upside surprise to boot. So if you get a number that's in line, in relative terms, that becomes a little bit of a disappointment. And if you get a number that's lower, in relative terms, that's a lot of a disappointment. We look at the way Eurozone economic data has behaved relative to expectations. It's improved a bit recently. This is the Citigroup Economic Surprise Index here. We can see that we're still in negative territory. That is, we're under the zero line. That's telling us that Eurozone economic data still tends to miss relative to forecasts, but it is approaching closer in on those forecasts over recent days. And so with that in mind, maybe we get a number that's broadly in line with expectations, tilting a little bit softer. If that's the case, after the markets expect an upside surprise in the wake of Germany's numbers, that might take the wind out of the euro's sails a bit and suggest the ECB is actually on track to be a little bit less hawkish than what today's numbers are implying. And then, of course, we're going to get inflation numbers across the Atlantic. The Bureau of Economic Analysis is going to publish the PCE, or the personal consumption expenditure version of U.S. inflation data. That's the Fed's favored inflation gauge. And here things get a little dicey. So the headline number is expected to come down to 2.1%. That's the lowest reading, if it comes out as expected, since February of 2021, and almost directly on the Fed's target. But that's not really where the central bank is probably looking. It's probably looking at the core, where things are expected to be a little bit warmer once you strip out the effects mainly of energy, which has been a main disinflationary force, but also the effects of food as well. That's admittedly a paltry influence here. When you look at this then, and you are left with where inflation lives, clearly it's mostly core services, which is where the Fed feels that it can have impact. As we've talked about before, the housing bit isn't really something the Fed has much influence on, because it and its rate hike cycle are a big part of the reason why those readings are still sticky. And once the rate cuts really build out and filter into the economy, you would expect that to unstick, both as sellers feel better about selling because they can refinance less expensive relative to where their outstanding mortgages already are, and because that then brings down the prices as people sell and buyers come back in. So what the Fed cares about is this service sector bit. And here, to the extent that that is approximated in core CPI, the dotted line here, we have a little bit of an issue. At 2.6%, we basically have stalled on the disinflation front going back to May. The average May through July is in fact 2.6%. If you squint, you can see this is a flat line now. And for the service sector, you can certainly see it clearly. In fact, the only thing that disrupts this is an uptick to 2.7% in August. So it looks like disinflation has hit a wall of some kind. When this happened earlier in the year, the Fed became, after about 3 months of this, reluctant to cut rates. And we saw them become a lot more hawkish in May and June before ultimately they had to pivot away from those kinds of ideas going into September. So what we have here now then is another scenario where the Fed might be hamstrung. And indeed, if we look at higher frequency readings, what we find is even though the monthly PCE numbers have been coming down, this is August, July, June, we can see that since June they've sort of steadily declined. Here is the standstill in the year-on-year numbers. Again, since May, we're not improving. We're not heading lower at this point. But more importantly still, when we look at the high-frequency indicators in the bars up here, the red ones are the 6-month annualized percent change. In the blue bars, the 3-month annualized percent change. And what we see is that for the higher frequency numbers, the 3 months here, in August, we saw the first rise in 3-month annualized inflation since March, which essentially just means that the most immediate data on inflation is telling us that were that to continue at the current rate for a 12-month period, we'd end up with higher inflation as of August than we would have if we did the same extrapolation in July. And it's the first time that we moved in the direction of higher overall inflation since March. So this is not going the Fed's way. And with that in mind, the Fed might well think, well, okay, if this is not going our way here, then perhaps what needs to happen is a bit of a delay on the path for these interest rate cuts. Now, when we consider what the Fed said when it last updated this in September with that fateful 50 basis point rate cut, essentially has them already in a corner to cut at November and December policy meetings. But the markets are now growing a little bit suspect as to whether that's actually likely. And after all, we continue to see, despite the slight GDP misstep, that U.S. economic data continues to surprise relative to expectations on the top side. And so as we consider this overall, we are still apparently in a position where U.S. economic data can more readily beat forecasts than not, even as this starts to get stuck here a bit. All of which perhaps comes down to the Fed getting a signal from this data that says, cool your jets. And in fact, the markets are in line with that kind of thinking, it would seem, because we continue to see this hawkish adjustment in overall policy expectations. Further climbing is the sum here of where rates are going this year, that's in the gray, and where they're going next year in the yellow. the sum here, 113 basis points now left on the menu, which is interesting because, of course, the Fed said, again, in its most recent forecasts, that we are looking at 100 basis points in cuts this year, 100 basis points next year. 50 basis points this year is already there. That would leave 50 basis points more, as we just mentioned, over November and December. At this point, the markets have already sought to price in one of those cuts, which is a meaningful step back from the more dovish setting even just a few weeks ago. The likelihood of that second cut now just 24%. The likelihood of getting to all four cuts next year, likewise diminished here. 3 cuts all the way baked in at this point, and the probability of a fourth at about 26, 27% or so. So things are already getting a little bit defensive here. Not surprising in that context. Of course, bonds have fallen, yields have risen, and the dollar is stronger as we get this readjustment. Stocks for now are just stuck and thinking of what to make of this. That may be perhaps a dissipation of the election or some such other thing, but as we mentioned at the top of the show, that does not preclude the emergence of trading opportunities elsewhere. And so the focus then goes directly to the euro. If we are going to get somewhat of a disappointment bias on the Eurozone inflation side of this as we move forward, meanwhile, the U.S. side might give a little bit more impetus to the reflation narrative, well, then perhaps this resistance at 109, 109.10 on the euro after this bounce, these are 6E euro futures, maybe that holds right here. And if it does, and if we ultimately run aground at this resistance and show signs of stalling, perhaps we then have a new entry point into what has been a precipitous decline. Maybe there's a new selling opportunity against the 109 figure that emerges here with an initial aim back to 108, and then beyond that 107 and 106.29, 106.30. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may head therefrom. I am typically on with Victor Jones for the Price of Truth on Wednesday, though we're off this week. Back with Chris for Futures Power Hour on Fridays and Mondays. On with Victor and Tom for First Call at the Global Market Open on Sundays. Writing for the news and insights portion of tastylive.com, and commenting sporadically on the platform formerly known as Twitter at Ilya Spivak. If you're watching this on YouTube, like and subscribe, and Macro Money will be back tomorrow. Happy trading.